Welcome to TradeDMBI.com. This is John. This report is for the 19th of July. Well, I went ahead and marked just for ease of understanding because we talk about positive extremes all the time and how important they are. And when we go down here, this was the positive extreme start right here at the beginning of July. And it corresponded to that. Now, of course, our expectation is that once we have a breakdown, we look for each of those to fill. And in this particular case, anytime we move below the ABM yellow, and it's safe to be short at that particular point and long above it. In this particular case, we had a series of positive extremes, and ES is filled all the way back to most of them. Our low was what are we looking at here? 55.70. So slightly above where this 55.59, which is the beginning of the breakout. And I wanted to give this relative view because once we had the breakdown of the magenta below 33 level and below the yellow, we also saw the corresponding breakdown even before this began of the blue underneath the gray, which sort of was the precursor. We were just waiting for a little bit of improvement of MBI white, which was show enough short activity to do something. And of course, while we do that, we're looking at here the DOC, where once it breaks below that negative 13, it's the effect of it coming from the top because this is a cylindrical concept, which is impossible to show on a 2D screen. Anyway, as long as below there, we expect weakness from within that setup, even though we had such strong move from shakeout readings and everything else. And so that's normal within a consideration, and we look for the expectation to move down to these. Now, what's interesting from a relative standpoint, if we flip to the NASDAQ, you can see from the NASDAQ's original breakout here on the extreme, same date and everything, corresponded perfectly. And then you can see the corresponding breakdown and the fact that short interest has been much higher relative. You didn't get that deep spike like we saw from the ES. So the broader market obviously performing higher, more effective than tech, so to speak. And you can see completely filled and actually went below and then settled right back above it, filling it completely. So this is where you have that divergence between the two markets. And it's important to see that because when the markets are misaligned, you get a little bit of more erratic behavior. It just shows that the secondary market is obviously more appealing at this particular stage than where tech is. And that's just because you've got, you might want to say, ahead of itself. But there's that realization that despite the joy and glee over AI, and this is, if you remember, for a few months back, we talked about this divergence. It reminds me a lot of the .com era breakout where you had WorldCom and all these things running cable and everything everywhere for this massive increase in internet, but it was just ahead of the time of the amount of usage that it was going to get. The problem for AI is not that there's a shortage of their wanting to use it, there's a shortage of power. They just can't get to it, and the cost of that crippling. And there's the divergence. The limited growth capability of AI is strictly a power generation situation. You're already seeing that they can't handle it. We talked about the same thing with EVs. Just isn't enough power generation being created for a variety of different reasons. And this push towards moving to green energy, which, for as long as they've tried, still can't outdo fossil fuels. The percentage that we're getting from green energy areas hasn't relatively changed that much percentage-wise, and that's just because the growth far outstrips its ability to do it, and the cost of green energy is higher than it is for fossil fuel. There's no other way around that. When we look at it from the NQ standpoint, you can see it's much weaker. We broke above the magenta with the MBI white, and even before the S&P did. We were already at reasonable levels up in that 7 range. Anything over that 6.5 has the potential for short strength. So even with the short-term buyers coming back into the NASDAQ in this particular case, not enough to stop that momentum of the move. Now you throw in the fact that it's expected that by this weekend Biden is out of the race. Markets don't like uncertainty, and when you have a certain situation, it's fine. Now you have an unknown because who's going to be on the other side? What happens in an open convention? Is it actually going to happen? Of course, the reports are that by Sunday, You've had too many of the head leaders. They postponed the virtual vote for the nomination, which they're doing, for the Democrats, which is interesting. No actual, regular voting. It's always virtual. Uh, so who are the real power brokers and who's actually been running things? If the president himself can't stop that from taking place, was he ever really in charge? Which I think is a realization that people are finally coming to, that things are not always as they seem. Now, of course, from a Treasury standpoint, ooh, that's scary because again, you can't really go to safety here. That yield is pathetic relative to what inflation is. And how do we measure our inflation? Well, we look at the real world and we look at energy costs and what it costs to actually do things, and those prices are going to continue to rise. So it's problematic. And there's no other place for people to put their money at this particular stage if you want to actually not have a negative yield, but in the market. That becomes problematic, and you get that stagflation situation when you have both a falling market and rising inflation. And this was something that, no shock. Of course, you had this unrealistic jump from the euro, which, of course, it was all based on the idea that the ECB might actually cut rates or whatever. They're not going to do that because they really can't. And it's not helping their growth situation. The next story coming out of the EU will be the looming energy prices crisis because, one, they have to buy their energy in fossil fuel, which has gone up, and they have to convert it into dollars. So, what do you want to be in a euro for? Makes no sense. But that doesn't stop these kinds of trades simply because they feel like they can get an advantage over, cross positioning, and that's why you have to remain flexible in these situations. From a gold standpoint, fill back into the positive extreme right here. Still isn't going to stop the overall. I mean, you're always going to have fits and spurts. We expected new highs to be broken out into gold. Fill that back in a little bit, it'll start another run. I think you'll see the same situation within crypto. You'll get periods of explosion, stabilization, and then a return. From the Bitcoin standpoint, you got other dynamics. You've got, like I said, the Mt. Gox situation. You've got reduced yield for miners, and whether that hash rate uh, affects, how many are being sold, because obviously if you're mining and paying full boat for electricity, you're not making any money, and you can either hold on and hope, but you can only do that for so long. Someone's got to pay the bills. So, this is where, energy is going to become the number one trade, and who can produce it and for how little. ETH, similar to Bitcoin in this particular state, is having, okay, 50K is pretty clear. I mean, we went red from back here at the peak, and boom, it's continued all the way through. Um, Convenient that, from the positive extreme breakout that I had talked about before, we had this level right here. We stabilized off it for a little bit, and then that's when the new setup, and of course that sets up these positive extremes from back over here at the beginning of July. Uh, Coming back to this setup, we have a few more to go. This was the original breakout right here. So from that level filled, and then we have some subsequent ones that were just a little bit fraction lower, were also filled. And then at the very beginning of them, right down about there, also filled. So I'll keep repeating it over and over again because it's an important thing. It's why I created that indicator, and um, it's relatively important because it gives you a clear idea of why we see things do, the real understanding of what support is based on what they've been doing from an algo standpoint. So they pushed everybody into the long side when they were already pre-positioned on the dip, moved it up, but then you have to get out. And you can't do it all at once, so they've got to create a little bit of noise to be able to liquidate that. And then once they've liquidated, they begin their shorting setup. Once they've got enough in the short setup there, one last push before driving it right back and doubling it up. So they doubled it on the upside and doubled it on the downside, and all beautiful and easily seen. I mean, this isn't any surprise. So we're not talking about some shock to the system. It's all relatively normal. When you look at it from an intraday standpoint, yeah, the market opened and then just pretty much sold off. And of course, um, I think a lot of it, it's justification. They always pick an opportunity, and the idea that you have this uncertainty with, uh, political leadership, and that it makes a difference, because where politics goes, money follows, and there's a reason for that, because it certainly has regulatory impact in a big way. So that makes a huge difference. But I just thought I'd share that viewpoint. So take that for what it is, and continue to follow the readings. As always, anything relevant, I'll put on the Skype chat for you. Have a good one. Trade well.